we're back. It's time for Ask Annex. Got a question? You head to the website, annexwealth.com, and look for the Ask tab. Joining us, Matt Morzy, Director of Research and a CFP. Welcome.
Hey, Danny.
Fred Coleman's a branch director, wealth manager, and a CFP. Hey, Fred.
Thanks, Danny.
First question on Ask Annex. I got an annuity years ago, but my goals and risk tolerance has changed. What options do I have?
It's a very common situation with annuities. On the surface, annuities sound amazing, right? Danny, I can give you guaranteed income, downside protection. How does that sound?
Magic.
Right? Sounds great. What's not to like about that, right? So annuities can work out if they fit into the plan. But what we know, as this caller said, goals change, risk tolerances change, family situations change. All those things change throughout time. So one thing about portfolios, some of it can be set it and forget it, but you want to have active management throughout. And also you want to have flexibility with your cash throughout. So if you start thinking about what'll happen 5-10 years from now, although we plan that out and we make assumptions, things change. So there's a few things you can do or a few different strategies, and I reached out to our financial planning team for this. Shout out to Corey on our financial planning team. All annuities are different, but there's a few strategies you can use. One of the first things you can do is withdraw the surrender-free amount each year. So a lot of annuities will have a part that you don't have to pay a high surrender charge on, and you can just slowly continue to draw that down and reinvest those funds into another investment vehicle.
I got to pay to get my own money?
Oh, yeah. Okay. Nothing is free with annuities. Another option is you can cash out the annuity altogether and reinvest it into something else. Again, you want to be conscious of what the surrender charges are. Are there any type of tax consequences? All those things you want to be conscious of before you go and cash it out. And then another option is a 1035 exchange. What that is really looking for a better annuity, something with lower expenses, a little more flexibility. If the annuity is inside of an IRA, it's a little more simpler to transfer. But depending on your situation, any of those options may work.
Next up on Ask Annex, Matt, I think this is for you. If Warren Buffett is hoarding cash, should we?
I would think we get a lot of questions either revolving specifically Warren Buffett or people that are, famous on CNBC, in terms of the things that they say in terms of how they're managing money. And the general answer is whatever they're doing is not necessarily going to be the right thing for you. They are either talking what their book is, or how they're doing things specifically, but they're in a much different situation that you are going to be in, that I'm in, that anyone else is. They're very unique in who they are and what they do. With Warren Buffett specifically, I was looking through this in terms of his annual letter just came out, and he even had a line in there that said, despite what some commentators currently view as an extraordinary cash position at Berkshire, the great majority of our money still remains in equities, and that preference won't change. So they might have more than normal, and it might, based off the dollar amounts that he manages, it is a large amount of money, but he's an equity investor, and that's what he does. One thing he also doesn't do, other than the cash in there to get interest, is he doesn't invest in fixed income. So for most people, they're going to want some blend of stocks and bonds in there, and the bonds are going to be the safer or less volatile portion of their portfolio. So Warren holding cash is not really going to be that comparable to many other people. One other thing too is just in terms of how he invests. Most people are investing, a couple shares of this, a couple shares of that. Even people who have, a few $1 million are going to have larger positions, but they're, somewhat unnoticeable when it comes to what percentage of a company you actually own. Where Warren Buffett owns like 25+% of certain companies. Of Occidental Petroleum, Kraft, he owns more than a quarter of what those companies are. So he's investing in a much different style than anybody else is going to be. And frankly, he's the guy that's in the position that when the economy is starting to fall, that the Federal Reserve and the Treasury Department called to bail out Goldman Sachs. So until one of us are in that position, I'm not sure if, we're going to be able to invest like he does.
Got it. Okay, final question on Ask Annex. This is a quote. I guess this is a bit of a rant. How are we supposed to distinguish between the myriad ETFs and mutual funds for things like QQQ, S&P 500, and others? And I see that. I guess I kind of get this question because you see all sorts of different names, but they contain those indexes.
Mm-hmm. Yeah, every major index provider, ETF provider, is probably going to have something that replicates an index like the S&P 500. They are going to be something that they don't have to put a lot of work into. They're passive indexes. They're generally not going to charge very much to do so, but it's a great way for them to, have assets on their platform and to manage more money for people. So they're all going to have something very similar. And at the end of the day, whether it's Vanguard or BlackRock or iShares, who are the three largest ones, they're going to have an S&P 500 fund that is essentially identical to the other ones. Maybe the only difference there is the fee that they charge. And that's really the most important thing I would look at when you're looking at something like that, because they're all going to be extremely liquid. You're not going to have to worry about getting in and out and how much the ETF is deviating from an index over time. It's going to be very minor, but the fee might make a difference. And it's silly enough, paying 0.03% to one firm and 0.09 to another, which is the difference between some of those ETFs, doesn't make a big difference, but I would rather pay 0.03 than 0.09 if I could.
I can get down with that math too.
Yep.
All right. Matt Morzy, Director of Research, also CFP. Thanks.
Thank you.
Fred Coleman's Branch Director, Wealth Management at CFP. Thank you.
Thanks, Danny.